The concept of a debt crisis is often shrouded in complexity, yet its implications can be devastating. As the United States grapples with its financial obligations, the question arises, is America headed for a debt crisis? To answer this, we must delve into the numbers, exploring the national debt, its growth, and the factors contributing to this financial predicament. Understanding the intricacies of the debt situation is crucial, as it affects not only the economy, but also the lives of everyday citizens. The national debt has been a topic of concern for decades, but recent trends suggest that the situation may be reaching a critical point. National debt refers to the total amount of money that a country's government has borrowed and not yet repaid. In the case of the United States, this figure has skyrocketed over the years, surpassing $31 trillion. This staggering amount is a combination of various factors, including government spending, tax policies, and economic conditions. When the government spends more than it collects in revenue, it borrows to cover the deficit, leading to an increase in national debt. The situation is exacerbated by rising interest rates and inflation, which can make servicing this debt more challenging. To fully grasp the current state of American debt, it is essential to look at its historical context. The national debt has seen significant fluctuations since the founding of the nation. After World War II, the debt-to-gross domestic product ratio was at a peak, but it gradually decreased during the post-war boom. However, the trend shifted in the late 20th century, with the debt steadily increasing due to various factors, including tax cuts, increased military spending, and economic downturns. The financial crisis of 2008 marked a turning point, leading to substantial government intervention and further debt accumulation. In recent years, the pace of debt accumulation has accelerated dramatically. The COVID-19 pandemic prompted unprecedented government spending to support individuals and businesses, resulting in trillions of dollars added to the national debt. This rapid increase has raised alarms among economists and policymakers who warn that such levels of debt could lead to long-term economic instability. The Congressional Budget Office projects that, if current trends continue, the national debt could reach over 100% of gross domestic product by the end of the decade. Interest rates play a critical role in determining the sustainability of national debt. When interest rates are low, borrowing is cheaper, which can provide some relief to the government. However, as the Federal Reserve raises interest rates to combat inflation, the cost of servicing the debt increases. This creates a vicious cycle where higher debt leads to higher interest payments, further straining the budget. In the coming years, if interest rates remain elevated, the government may face significant challenges in meeting its debt obligations, potentially leading to a fiscal crisis. Economic growth is a vital factor in assessing the sustainability of national debt. When the economy grows, tax revenues increase, making it easier for the government to manage its debt. However, if economic growth stagnates or declines, the burden of debt becomes more pronounced. The current economic landscape is marked by uncertainty, with inflationary pressures and supply chain disruptions impacting growth. If the economy fails to rebound robustly, the government may struggle to generate the necessary revenue to service its debt, raising concerns about a potential crisis. Political decisions significantly influence the trajectory of national debt. Legislative measures such as tax cuts or increased spending can either exacerbate or alleviate the debt situation. The polarized political climate in the United States often leads to gridlock, making it challenging to implement comprehensive fiscal reforms. Both major political parties have differing views on how to address the debt issue, with some advocating for austerity measures while others push for increased spending to stimulate growth. This lack of consensus complicates efforts to create a sustainable fiscal policy. Public perception of the national debt varies widely, with many citizens unaware of the magnitude of the issue. While some view national debt as a necessary tool for economic growth, others see it as a looming crisis that could threaten future generations. Educating the public about the implications of rising debt is crucial for fostering informed discussions and encouraging civic engagement. As citizens become more aware of the potential consequences of unchecked debt accumulation, they may demand more accountability from their elected officials. The consequences of a debt crisis can be severe, affecting various aspects of society. A default on government debt could lead to skyrocketing interest rates, a collapse in financial markets, and a loss of confidence in the U.S. economy. This could trigger a recession, resulting in job losses and reduced public services. Additionally, a debt crisis could disproportionately impact vulnerable populations, exacerbating existing inequalities. The ripple effects of such a crisis would be felt globally, given the interconnectedness of the world economy. Addressing the national debt crisis requires a multifaceted approach. Policymakers must prioritize fiscal responsibility, balancing the budget while promoting economic growth. This may involve reevaluating spending priorities, reforming tax policies, and enhancing revenue collection. Additionally, investing in education and infrastructure can stimulate growth, ultimately helping to reduce the debt-to-gross domestic product ratio. Collaboration between political parties and a commitment to long-term solutions are essential for mitigating the risks associated with rising debt. The future outlook for America's debt situation remains uncertain. While some experts believe that the economy will rebound, allowing for manageable debt levels, others warn of the potential for a crisis if proactive measures are not taken. The next few years will be critical in determining the trajectory of national debt and its implications for the economy. As the nation navigates these challenges, it is essential for citizens to stay informed and engaged in discussions about fiscal policy and its impact on their lives. The question of whether America is headed for a debt crisis is complex and multifaceted. While the numbers paint a concerning picture, the potential for economic growth and responsible policymaking offers a glimmer of hope. It is crucial for both citizens and leaders to recognize the importance of addressing the national debt proactively. By fostering a culture of fiscal responsibility and informed decision-making, America can work towards a sustainable financial future, ensuring that the burden of debt does not fall disproportionately on future generations. Understanding the numbers and their implications is the first step toward a more stable economic landscape. If this breakdown helped you understand where America's debt is really heading, hit like, subscribe, and turn on notifications. We follow the data, so you're not blindsided by what comes next. Thanks for watching.